morning and welcome to the Deep Dive.
Glad to be here.
This is our Bulls, Bears, and the Barbell Deep Dive for the week, starting October 6th, 2025. And we're definitely kicking off a week that feels, well, loaded with tension.
That's a good way to put it. A lot hanging in the balance.
So our mission today is pretty clear. We need to pull together all the pre-market action, what's on the economic calendar, some early earnings whispers, basically figure out which way risk assets might break.
Right, synthesize it all. Because if you just glance at the big U.S. index futures right now, the S&P 500, NASDAQ, Dow contracts.
Yeah, you might just shrug. Right, they're kind of flat, maybe slightly up, slightly down. Very non-committal looking, almost boring at first glance.
Exactly. And that shrug, that's actually where we need to zoom in. Because that surface calm is, frankly, deeply deceptive.
Deceptive how?
It's hiding an extreme level of activity, of churn, underneath at the individual stock level. We're not in some broad bull market, definitely not a uniform bear market either. We are really deep into what you could call a barbell market structure. Okay, let's unpack that right away. Barbell market. That sounds like the key paradox for you, the listener, to really get your head around this week. Why are the big indexes just sort of treading water while single stocks are swinging, 15, 20, even 30% or more?
Yeah, think about that literal barbell, the weightlifting kind. All the weight, all the capital, it's piled onto the two ends, right? There's almost nothing solid or stable holding up the middle.
Okay.
So on one end of this market barbell, you've got these massive, very focused flows of capital pouring into high-risk, often speculative narratives. So we're talking AI infrastructure plays, certain crypto miners, critical minerals, things based on huge future potential, momentum.
Got it. Big bets on the future.
Big bet. And then on the other end of the barbell, it's swift and severe punishment. Any company that shows even a whiff of bad news, maybe negative fundamentals, regulatory trouble, a weak balance sheet, boom, they get absolutely crushed. Double-digit drops, sometimes instantly.
And that middle part being empty, that's crucial too, isn't it? The sort of average,
Yeah.
okay companies.
Totally crucial. The mediocre ones, the companies with just okay balance sheets, maybe okay growth prospects, they're being starved of oxygen right now. Institutional money is either sitting on the sidelines, hoarding cash, waiting for the Fed, or it's aggressively chasing those two extremes. They're high flyers or perceived safety. There's just no appetite, no tolerance for an average result when risk-free treasury yields are offering you a decent return anyway.
So the passive index funds maybe keep the top level looking okay.
Right. They provide a sort of floor, keep things generally flat or buoyant.
Yeah.
But the active money, the supposedly smart money, it only wants to pay up for two things right now.
Yeah.
Those high-conviction future stories or rock-solid safety. Everything else in between is just ignored.
Okay. So the big mission for us and for you listening this week is really about figuring out which force wins out. Is it the speculative micro-momentum pushing the gainers up?
Or is it the hard macroeconomic reality, the Fed actual earnings data that brings things back down to earth?
It feels like a confrontation is brewing.
Definitely. We're about to see a major test.
All right, let's ground ourselves in that macro picture first, starting with the immediate signals from U.S. index futures this morning. The data we're seeing shows a really interesting divergence, doesn't it? It tells a story about where the market's residual strength actually lies.
It really does. If you look at the NASDAQ 100 futures, that's your big tech, growth-heavy index.
Right.
Those contracts are showing modest gains in the pre-market. It suggests that, that long-running theme of growth stocks outperforming, the idea that future tech earnings justify higher prices, it's still hanging on. Barely maybe, but hanging on.
But step away from tech and it's different.
Yeah, step away and the story shifts.
Yeah.
The Dow Jones futures, the US 30 heavy on industrials, financials, healthcare giants, they're pointing to a slightly negative open. It's specifically down about 0.24% last check.
Okay.
And the broader S&P 500 futures, the US 500, also sitting slightly in the red, about minus 0.13%.
So weakness in the big, broad, established names.
But then, what's fascinating, look at the Russell 2000. That's your small cap index, right?
Yeah.
Lots of smaller, domestically focused U.S. companies, often seen as a read on the health of the domestic economy itself.
And
It's actually holding a decent gain, around plus 0.41%. So that divergence is really loud. It says the market isn't freaking out about local small business activity. Not yet, anyway.
It's more worried about the big global cyclicals in the Dow, or maybe just the overall valuation of the S&P ahead of all this Fed risk?
I think that's exactly it. It sounds like the big players, the institutions, are taking a very clear wait-and-see stance. And you can see that reflected in the fear gauge, can't you?
The VIX, yeah, the SIBO Volatility Index. With the main indices so indecisive, what's it telling us? It's holding pretty subdued, actually, around 16.65.
Right. And if you hear 16.65 on the VIX, especially knowing we've got this potential government shutdown messing with data, plus a huge Fed week, you should not read that as calm or confidence.
No. So what should we read it as?
You should read it as fragile composure. Really fragile.
Why fragile at 16.65? That doesn't seem super high.
Because a VIX there, in this context, doesn't signal peace. It signals that the sophisticated players, the big options traders, they're positioned pretty neutrally. It's like everyone's pulled up a chair to the high-stakes poker table, but nobody's actually putting their big chips down yet because they know the dealer, in this case, the Federal Reserve, is about to reveal a crucial card. They're holding their breath.
Waiting for that catalyst.
Exactly. Waiting for the monetary policy signals this week to provide that strong, singular push that breaks this logjam.
Yeah.
Either way, right? Up or down. They're pricing in the chance of a big move, the probability of volatility, but they're not betting heavily on the direction just yet. Hashtag 1.2 fragmented international context.
And this lack of strong directional conviction, it's not just a U.S. thing, is it? The global picture looks pretty fragmented, too.
Yeah, very fragmented, which kind of underscores the point that there's no single, powerful global economic story driving risk assets right now. Everyone's sort of looking around waiting.
So what are we seeing internationally?
Well, look across the Atlantic. That muted tone in the U.S. futures. It's mirrored pretty closely in Europe. Major indices like the German DAX are kind of drifting lower. The French CAC 40 is down a bit more clearly, minus 0.42%.
Suggesting maybe continued caution about manufacturing energy outlook there.
Probably. And then conversely, the UK's FTSE 100, it's managing gains, but they're tiny. Just plus 0.03%. So really no consensus at all in Europe.
And Asia overnight, same sort of mix.
Pretty much the same fragmented story, yeah. It's driven more by local factors than some big global wave. Japan's Nikkei 225, it finished almost flat. Suggests maybe domestic strength there is kind of balancing out the global worries.
Okay.
But then Hong Kong's Hang Seng Index, that had a noticeable drop, down 0.67%. Probably still wrestling with those ongoing property sector and broader economic concerns in China and the region. Meanwhile, mainland China itself, the Shanghai Composite, actually posted a moderate gain, so it's all over the place.
So what does this fragmented global picture really tell us as investors?
I think it highlights a really crucial point for you listening. It puts even more pressure on the U.S. macroeconomic communications this week, particularly the Fed. The world market is basically looking to the U.S. for direction, for some kind of clarity. If the U.S. can't provide it, this global indecision probably just continues.
All right, let's dive into the micro level now, because this is where the action is. This is where that barbell structure you mentioned becomes just impossible to ignore. Let's hit that extreme risk-on side first, the leading gainers. These are companies grabbing investor attention, fueled by these really compelling stories, often completely overshadowing their current bottom line, right?
Totally. It's a trader's environment on this side of the barbell. Pure momentum and narrative. And the biggest story this morning, just a perfect textbook example of the barbell's speculative end, is Critical Metals Core, ticker CRML.
Yeah, soaring, what was it, up over 46%?
Incredible, right? Plus 46.80% in pre-market. And the catalyst is purely about capital, a capital injection that also acts as a huge validation stamp.
They landed that big $35 million PI-PE deal, private investment in public equity. And the volume was just insane, 155 million shares traded versus an average of like 5 million. What makes a PI-PE deal so powerful for a company like this, a metals explorer?
Okay, two things. First, the institutional name involved. That's the key analysis point. For a company that's still in the development stage, focused on these really strategic assets like rare earth metals.
Their Tanbreeze deposit in Greenland, right, stuff needed for defense, EVs.
Exactly. For them, capital is absolute lifeblood. This $35 million isn't just operating cash, it's a massive third-party stamp of approval. Some established institutional investor did their homework, kicked the tires, and is now publicly backing the long-term value of these assets.
So the market sees that as a huge de-risking event.
Huge. Far more impactful than, say, a slightly better than expected quarterly revenue number would be for a company like this. It validates the whole long-term story.
Okay, moving along that narrative track, 8Co Holdings, ORBS, up over 34%. This looks like the power of a strategic pivot and a ticker change.
Yeah, ORBS, formerly OCTO. They changed the ticker to signal this big shift towards the proof of human concept in the age of AI.
proof of human.
Right. And this is a perfect example of capital chasing, the right buzzwords, AI, identity verification. But crucially, they're backing it up, or seem to be, with serious action. They announced a massive $270 million private placement.
Wow, $270 million.
Yeah, and it's specifically earmarked to fund what they're calling a first-of-its-kind WorldCoin treasury strategy, leveraging WorldCoin's iris scanning orb technology.
Okay, wait. I got to push back a bit here. Iris scanning, WorldCoin, a ticker change. Isn't that just pure hype? How does the market justify a 34% pop on that, especially if the underlying financials might be, let's say, mixed?
It's a fair question. It justifies it based on perceived runway and credibility enhancement. That $270 million buys them years of time to try and execute this high-growth story without need to tap the markets again soon. That's huge in this environment.
So it buys time.
Buys time. And they boosted the credibility factor by bringing in Dan Ives, who's, a very well-known tech analyst, as their new chairman. So you combine significant cash, a very future-focused narrative, proof of human, AI, and this perceived boost in board competence.
And momentum traders jump on board.
They can't ignore it. It's basically buying the story and, crucially, buying the time needed to see if the story plays out.
Gotcha. Okay, Solid Power, SLDP, another big gainer, up over 34%. But you said the catalyst here isn't really today's news.
It's more of a technical breakout building on momentum from recent positive signals. SLBP is in that solid-state battery space. Hugely volatile because the tech challenge is immense, but the payoff, if they succeed, would be, enormous.
So what sparked the recent move?
It seems to be a combination. An analyst upgrade from Needham, they doubled their price target from $2 to $4, citing actual battery progress they observed. That came alongside some better-than-expected Q2 revenue numbers earlier.
So good news created a setup.
Exactly. It created a favorable technical picture, the stock pushed through some key resistance levels, and now you're seeing momentum money flooding in, betting on further progress in electrification, solid-state batteries, and just capitalizing on that technical chart setup.
Makes sense. Then we've got HIVE, Digital Technologies, HIVE, rallying strongly too, up over 25%. And they seem to be playing both sides of the hot tech trends, crypto and AI.
Perfectly tailored for this market, right?
Yeah.
They're executing this dual strategy very effectively, it seems. On the crypto side, their core business, they've scaled up significantly. They just surpassed a mining capacity of 21 exahash per second, EHS.
Okay, 21 EHs, put that in context. What does that mean practically?
It's a measure of their raw computing power, basically how fast they can run the calculations needed to mine Bitcoin and secure the network. Hitting that scale means they're producing a pretty consistent and substantial amount of Bitcoin, currently around 9 BTC per day.
So they're optimizing the cash cow, the mining, but it's the AI angle that really grabs attention in this kind of market.
Absolutely. That's the narrative accelerator. They're diversifying aggressively into the hottest theme out there by buying a 7.2 megawatt data center up in Toronto. And it's not just for more mining. It's specifically to build out their high-performance computing, their HPC, and AI service offerings.
So scaling the profitable core and moving into the next big thing.
That's the sweet spot. It attracts both the value guys looking at the hard assets and current cash flow, and the momentum guys chasing the AI narrative. Best of both worlds in this barbell setup.
And lastly on the gainers, we should quickly mention BTQ Technologies, right? Up almost 30%.
Yeah, BTQ up 29.57%. And this one seems almost entirely driven by analyst commentary. Eric Jackson, a hedge fund founder, publicly made the case that BTQ was way undervalued compared to its competitor, Quantum Computing Inc., actually.
Interesting contrast. We'll get to QBBT on the loser side.
Exactly. But that kind of influential endorsement, even just an opinion, can be another huge non-fundamental driver on this speculative end of the barbell. Plus, BTQ also announced they hired some key people from Radical Semiconductor to speed up their quantum-safe hardware development. So again, substantiating the future story.
Okay, let's swing that barbell all the way to the other side. The side operating with, as you said, zero tolerance. The market showing extreme speed in punishing anything that looks like an immediate real threat to profits or shareholder value.
And Applevin Corp, ticker APP, is leading the charge downwards today, down a very painful 16% in pre-market.
Ouch. What happened there?
The catalyst was a Bloomberg report. Apparently, the U.S. SEC, the Securities and Exchange Commission, has launched an investigation into the company's data collection practices, and it was reportedly triggered by a whistleblower.
Wow, okay. That's a huge cloud of uncertainty appearing instantly, especially for a tech company that, until recently, was actually one of the S&P 500's top performers this year.
It's the ultimate headwind in this kind of nervous market, regulatory risk. It's immediate, It's untradeable. You can't quantify the potential outcome easily. Institutions just hate that.
They don't wait around to see how it plays out.
No way. Especially not when the Fed might be about to hike rates again. The safest move, often triggered by algorithms programmed to react to keywords like SEC investigation, is just to dump the shares and de-risk the portfolio immediately. Sell first, ask questions later.
Got it. Then we have Quantum Computing Inc., QUBT, down over 10%. And this is fascinating because it's happening despite them announcing a heavily oversubscribed $750 million private placement. That sounds like good news, doesn't it? Raising a ton of money.
It sounds good, but this is the perfect illustration of that conflict between needing cash for the future and the immediate cost to current owners. It's classic dilution pain.
Explain that. Why is raising money bad here?
To get that $750 million, QUBT has to issue a lot of new shares, roughly 37.2 million new shares of common stock. So, well, yeah, the cash infusion is great. It strengthens their balance sheet, funds them through 2028, apparently.
Which sounds amazing for a speculative tech company.
That sounds amazing long term, but today, it immediately and significantly waters down the ownership stake of everyone who already held shares. Their slice of the pie just got smaller, and future earnings per share get diluted too.
But isn't that incredibly short-sighted? To punish a company for securing its future for the next 4 years just because of immediate dilution.
Welcome to the barbell market. In this structure, many investors seem to demand either immediate wins or immediate safety. Those who bought QUBT at higher prices see their ownership percentage shrink today and they hit the sell button. They're prioritizing protecting their current equity value over that long-term benefit of a guaranteed funding runway. It really highlights that short-term, almost trader-like mentality dominating this volatile end of the market.
Okay, that makes sense in this context. We also see ongoing weakness in some established names like Hertz Global Holdings, HTZ, trading down sharply again, almost 10%. No specific news today.
No big headline today. It looks like the market just showing its fatigue with ongoing operational problems. Hertz seems stuck in this deeply negative trend. Recent reports keep highlighting the same issues. Persistently high operating costs, a really heavy debt load, and just consistent red ink on the bottom line negative net income around $294 million last quarter.
So without any positive news, the default is just down.
Pretty much. Investor skepticism about their ability to actually pull off a sustainable turnaround just keeps weighing on the stock. It feels like death by 1,000 cuts, really, just bleeding lower in the absence of good news.
And finally, on the downside, we saw a really synchronized drop in the manufactured housing sector. Cavco Industries, CVCO, down over 13%, and Champion Homes, SKY, down over 8.5%. That feel like a sector call, not company-specific news.
Definitely a sector signal. This looks like pure preemptive de-risking, selling before potential bad news hits.
What bad news?
Interest rates. Housing affordability is obviously tied directly to mortgage rates and financing costs. Investors are dumping exposure to this sector now because they anticipate that the Fed communications and the inflation data coming this week are going to confirm a higher for longer interest rate environment.
So if borrowing costs go up,
Demand for manufactured housing, which relies heavily on consumer financing, takes an immediate hit. So the market's trying to get out before the Fed officially confirms those higher rates, getting ahead of the curve.
Okay, so this sets up the big clash perfectly. You've got this momentum-driven micro market on one side.
Yeah, the AI stories, the metals, the breakouts.
Running headlong into this much harsher macro reality check on the other side. And we have to remember, right, the backdrop is still this ongoing, hopefully temporary, U.S. government shutdown, which messes with the normal flow of economic data.
Exactly. And that disruption actually amplifies the importance of whatever data and commentary does get released. It raises the stakes because the market might overreact to any single data point or Fed comment simply because there's less other information to balance it out.
So every release this week carries extra weight.
Precisely.
Yeah.
If we don't have the usual steady stream of info, any piece we do get, especially from the Fed, could be treated like gospel. The market could swing really hard on it.
Yeah.
Which brings us to the absolute central event risk this week. The Federal Reserve's communications blitz. Hashtag 3.1. The Federal Reserve Communications Blitz.
Right. And the absolute highest impact event is the release of the FOMC minutes on Wednesday. This isn't just a summary, right? It's the detailed, sort of behind-the-scenes look at their last big policy meeting. What specifically are traders and investors going to be digging through in those minutes?
They'll be using microscopes, basically, looking for really subtle shifts in the language around three key things. First, inflation trends. Are they seeing progress or still worried? Second, the labor market. How strong do they think it really is? And third, the big one, the precise conditions they need to see for any future interest rate moves, up or down.
Like, are they starting to worry more about over-tightening and causing a recession, or are they still laser-focused on getting inflation down no matter what?
Exactly. Are they focused on lagging indicators showing maybe some softness, or still aggressive on forward-looking inflation risks? They'll be hunting for any nuance, any change in adjective describing how restrictive policy needs to be.
And that idea of restrictiveness, that ties directly back to the valuations on the speculative side of the barbell, doesn't it?
No.
We need to explain that core concept, the discount rate.
Yes, this is absolutely critical for listeners to understand, especially if they're looking at those high-flying growth stocks. For a company like, say, Critical Metals or Eightco Holdings, their value today isn't based on profit now. It's based on the huge profits they hope to make 5, 10 years down the road.
Okay.
Higher interest rates are devastating for those kinds of valuations. Why? Because the prevailing interest rate acts as the discount rate. It's the rate you use to calculate the present value of those future uncertain profits.
It's like the hurdle rate those future profits have to clear to be worth something today.
Perfectly put. It's the hurdle rate. When the discount rate goes up, the present value of those far off, maybe hypothetical future profits, it shrinks dramatically. If the cost of money is, say, 5%, those future dollars are worth way less today than if the cost of money was only 1%.
So a hawkish signal from the Fed.
A hawkish tone in those FOMC minutes, anything confirming this higher for longer rate path, could instantly pop the speculative bubble. It does it by raising that discount rate applied to all those promised future earnings. It just fundamentally devalues that whole growth sector almost overnight.
And it's not just the minutes this week. We've got a whole parade of Fed officials speaking publicly, right? An unusually busy schedule.
Yeah, it's packed. We hear from Chair Powell himself, Bostic, Bowman, Kashkari, Barr, Goolsbee, Daly. A lot of different viewpoints, potentially.
So what are we listening for from them? Just consistency.
We're listening for any divergence in tone, any cracks in the consensus. Is someone like Bostic, who's often seen as a bit more optimistic or dovish, suddenly sound more worried about the economy sticking? Does a known hawk like Bowman maybe soften her stance slightly?
Any sign of disagreement.
Any difference in rhetoric could signal that there's a growing debate within the committee about the right path forward. And that kind of division, it creates uncertainty, which, as we know, the market absolutely hates. Hashtag tag 3.2 key economic reports and treasury supply.
Okay, so Fed talk is huge. But beyond that, we do still get some crucial high-frequency data points this week. Updates on those pillars of the economy, labor, and the consumer. Thursday, we get the jobless claims numbers.
Right, initial and continuing jobless claims. It's our most frequent check on the labor market's pulse, which, as we keep saying, has been the main thing holding up the U.S. economy and allowing the Fed to stay aggressive.
What are people expecting there?
Consensus for initial claims is hovering around 223,000. If we see a sharp spike upwards from that, it could be seen as an early warning sign that demand is finally softening, maybe forcing the Fed to reconsider things.
But if claims stay low.
If they stay stubbornly low, it just reinforces the Fed's hawkish stance, gives them cover to keep rates high.
And then Friday, we get the University of Michigan Consumer Sentiment Survey. The headline number matters for confidence, but there's a specific component the Fed watches like a hawk, isn't there?
Absolutely. The most critical piece in that report is consumer inflation expectations.
Yeah.
What do regular people expect inflation to do over the next year or 5 years?
Why is that so important to the Fed?
Because expectations can become self-fulfilling. If people expect prices to keep rising rapidly, they might demand higher wages or rush to buy things now before they get more expensive. That behavior itself can fuel inflation.
So what's the market looking for in that number on Friday?
Well, the consensus is tracking expectations for the year ahead at around 4.5%, which is actually down just slightly from 4.7% last time. If that number holds or falls further, that's good news for the Fed, might be seen as dovish. But if it unexpectedly ticks higher,
Trouble.
yeah, that would immediately reinforce the hawkish arguments of the Fed. It would put instant upward pressure on rate expectations and basically validate all the preemptive selling we saw today in sectors like housing.
We also need to keep an eye on the Treasury market itself, right? Specifically the auctions this week.
Yes, definitely. Sales of 3-year, 10-year, and 30-year government debt. These auctions are a really important barometer of investor demand for U.S. debt and also the sort of structural supply-demand balance in the bond market.
And the key ones are the longer-term auctions.
The demand for the long-duration stuff, the 10-year, and especially the 30-year bonds, is critical because the yields on those bonds influence long-term interest rates across the whole economy. Mortgages, corporate borrowing costs, everything. If demand at these auctions looks weak, if investors demand higher yield to buy the bonds,
Then yields rise, tightening financial conditions even more.
exactly, it tightens conditions passively, regardless of what the Fed officially does or says next. So weak auctions could be another headwind for the market.
Okay, and then layered on top of all this macro data and Fed speak, we're easing into the unofficial start of the Q3 earnings season. And again, we see that disconnect you talked about. The market's speculative side is focused on these high-growth companies that mostly aren't reporting yet.
Right.
While the actual fundamental data points this week come from these big bellwether old economy names, they're going to provide a really vital reality check, aren't they?
They absolutely are. Consumer strength is one of the biggest question marks right now, and these early reporters are right at the coalface. Like on Monday, we get Constellation Brands, STZ, they own Corona, Modelo, a bunch of wine and spirits, a key proxy for discretionary spending.
So the question is, are people still buying the pricier beer and wine?
That's exactly it. Investors will be tearing apart their volume trends, especially in beer. And crucially, what's their outlook for the holiday season? That's huge for them.
What's the earnings number expected?
The consensus EPS estimate is around $3.37. But beyond just hitting the number, the focus will be on margins. Have they successfully navigated higher input costs? Are they seeing any signs that consumers are starting to trade down to cheaper options? Even a slight hint of volume weakness could signal that consumers are really starting to pull back on those premium purchases.
Okay. Then Tuesday brings McCormick and Company, MKC, spices, seasonings, a staple in pretty much every kitchen. Their report feels like a check on the household budget itself and margin pressures.
Yeah, consensus EPS there is about $1.82. McCormick is the perfect case study for inflation impacts. Investors need to see if they still have pricing power. Can they pass along their own higher costs to us, the shoppers, without losing too much volume?
And are people maybe switching to the store brands?
That's the other key thing. Are they seeing a rotation away from their name brands towards cheaper private label alternatives? If consumers are cutting back even on basic staples like spices, that's a pretty strong warning sign about ongoing household budget stress.
All right, but maybe the most significant cyclical report this week, the biggest non-Fed factor potentially, is Delta Airlines, DAL, reporting Thursday morning before the bell.
Delta's huge. It's way more than just an airline stock. It's seen as a vital proxy for the health of the entire travel industry, yes, but also for broader economic activity. It gives you a real-time read on both business and consumer confidence.
So what are the key things the market will scrutinize in Delta's report and call?
Booking trends, first and foremost. Are business travel bookings recovering like they hoped? Is leisure demand holding up even with higher ticket prices? Then the impact of volatile fuel prices on their margins, that's always huge for airlines. And finally, the domestic versus international picture. Is strong international travel still making up for any potential softness domestically?
So a strong report from Delta could really boost that soft landing idea.
Absolutely. Strong results would suggest travel demand is resilient, business activity is stable, maybe supporting broader market optimism. But
weakness?
Weakness would provide tangible, hard evidence that the economy is slowing down, a fact that the high-flying gainers on the barbell are currently choosing to ignore. Weakness at Delta could easily trigger that rotation away from speculative growth and back towards more defensive, cash-generating parts of the market.
Okay, so let's try and pull all these threads together. If we synthesize everything we've just unpacked, the market really does feel poised for a major clash this week. You've got this powerful, conviction-driven micro-environment.
Yeah, the AI frenzy, the rare earth excitement, the crypto AI combo plays, the technical breakouts, fueled by very aggressive capital flows.
But it's running smack into this very cautious, very restrictive macro environment, driven almost entirely by the Federal Reserve and its fear of sticky inflation.
And the outcome for the week, maybe even for the next month or so, really seems to hinge on two specific, very high-stakes inflection points. Think of them as the two main gravity checks for this whole barbell market structure.
Okay, inflection point number one.
The FOMC minutes on Wednesday.
Mm-hmm.
If those minutes come out with a clear, unambiguously hawkish tone, maybe emphasizing how stubborn inflation still is, or really committing to that higher for longer rate outlook, well, that translates immediately into a higher discount rate for all future earnings.
Which hurts the growth stocks the most.
Exactly. It starves that speculative side of the barbell of its oxygen. It forces massive valuation adjustments and could easily trigger a really rapid unwinding of some of those crowded momentum trades. Deleveraging.
Okay. And the second major point of contention this week.
Delta Airlines earnings on Thursday. As we just discussed, it's the most significant corporate release from a true cyclical bellwether this week. Strong results. That supports the soft landing story, suggests robust demand, maybe boosts broad market optimism.
But weak results?
Weak results provide that hard, tangible evidence of an economic slowdown that the gainers are ignoring right now, that could easily trigger a sharp rotation away from speculative growth and towards safety, towards defensive assets, towards companies generating actual cash today.
So this tension, this clash between the micro-narratives and the macro reality, that's really the defining feature of the market right now for this first part of October.
Absolutely. The big question is, can these powerful momentum narratives driving individual stocks like CRML or ORBS or HIV actually withstand this incoming barrage of hard data? The Fed's view, the inflation expectations, the reality check from Delta, that's the high-stakes test that will likely set the market's dominant tone for maybe the rest of the year. Tag outro.
Wow. Okay, this has been a really intensive look under the hood at what's truly driving things right now. I think the core takeaway for you listening is probably this. Stop focusing only on those flatlining broad market indices. They're hiding the real story. Instead, focus on how these specific high-conviction catalysts, whether it's positive validation like a PIPE deal or negative punishment like an SEC probe or dilution, how those are driving the actual capital flows right now. But stay hyper alert, constantly scanning for those signals from the Federal Reserve because, as we've laid out, the Fed still holds the trump card. They possess the power to change the entire narrative, the entire market structure, almost instantly.
And that leads perfectly into maybe a final provocative thought for you to chew on this week. We saw these incredibly extreme reactions today just around companies raising capital, right?
Yeah, the contrast was stark.
Critical metals, CRML, soared plus 46% on a $35 million PIPE deal. The market saw it as validation, giving them a long runway. Fantastic news.
Right.
Quantum computing, QUBT, plunged over 10% on announcing a huge, oversubscribed $750 million placement. The market saw it purely as punishment for diluting existing shareholders today. Terrible news, apparently.
Even though it funded them through 2028?
Even though it funded them for years. So the market is clearly prioritizing immediate access to capital, securing that long runway today, maybe even more than it's valuing actual current profitability or near-term fundamentals.
It's buying time for the story to play out.
It's buying time. But here's the question. If the market is rewarding companies so highly just for getting their funding secure now, what happens to those valuations if the Fed confirms this week that we're entering an environment of permanently higher borrowing costs? What happens when the next capital raise becomes exponentially more expensive or maybe even impossible for some?
If that easy money really is gone for good, the market might suddenly discover that the narrative alone, that story, just isn't enough to sustain the incredibly high valuations on that speculative side of the barbell. And that potential shift in perception, that's the critical thing we'll be watching for this week and beyond.